Just 2 days ago, Jerome Powell stood at the podium for the final time as the chair of the Federal Reserve. And in 47 minutes of carefully prepared remarks, he contradicted his own data 5 separate times. That's right, 5. He told America people are still spending on the same day University of Michigan consumer sentiment hit its lowest reading in 74 years of survey history. He raised the Fed's 2026 GDP forecast to 2.4, while the Atlanta Fed had theirs at 1.2%. He called the most divided FOMC vote since October 1992 a committee that's moving towards a more neutral place. He pledged to keep a low profile as a governor, and then in the same press conference called the administration's actions, and I'm quoting him directly here, illegal attacks on the Fed. And this is my favorite one. He ended his final press conference with the line, "I won't see you next time."
I won't see you next time.
And then confirmed he is not actually leaving the building until January 28. You know, that building that Trump came to see him in and said it was over budget? That building. I swear, I'm not trying to be controversial here. I'm just going to audit the official transcript against the official data. So you can decide whether you want to keep believing this nonsense or if you want to open your eyes to the real data. Today, I'll walk you through every single contradiction, why this matters more than the rate decision itself, and where this institutional fracture sits inside the 18-year cycle, because everything is connected right now. So let's start with the setup, because the setup is the credibility foundation for everything that follows. The FOMC held the federal funds rate at 3.5 to 3 3/4 for the third consecutive meeting. The vote was 8-4. This is the most divided FOMC decision since October 92, a 34-year record. And here is a part the financial press largely glossed over. The 4 dissents went in opposite directions simultaneously. Governor Stephen Moran, who was appointed by Trump and is naturally following orders, pushed for a rate cut right now. Beth Hammack of Cleveland, Neil Kashkari of Minneapolis, and Lori Logan of Dallas wanted more hawkish posture and opposed any easing bias in the statement. Analysts describe this split as the dissenters staking out the battle lines for the incoming chair. And still, Powell insisted on describing it as a committee finding consensus. Obviously, it's not. It's a committee fracturing along the exact fault lines Kevin Warsh will inherit when he is sworn in. And by the way, Warsh cleared the Senate Banking Committee that same morning on a 13-11 party line vote. The first fully partisan committee vote on a Fed chair nominee in the history of the institution. Full Senate confirmation expected the week of May 11. So that is the setup. Most divided Fed in 34 years, first partisan chair nominee ever, a sitting chair with 16 days left, and a press conference about to deliver 5 contradictions in a row. So let's walk through these together. Contradiction number 1. Powell looked into the camera and said, and I'm quoting verbatim from the transcript, "The US economy has just powered through shock after shock. People are still spending." On the same day, the University of Michigan released its final April consumer sentiment reading, 49.8. The lowest reading in the survey's 74-year history. Lower than 2008, lower than the COVID shutdown, and lower than the 2022 inflation panic. 74 years of data, and yesterday's print was the worst one ever recorded. But it gets sharper. 1-year inflation expectations jumped to 4.7 from 3.8 the month prior. 5-year expectations climbed to 3.5. Translation, the average household has stopped believing the Fed can actually fix this. And it's not just one survey. Gallup's April poll found a record 55% of Americans say that their personal financial situation is getting worse. That is the highest reading since Gallup started asking the question in 2001. Gallup's economic confidence index dropped 11 points to -38. So when Powell says people are still spending, he is technically not lying. Retail sales did rise 1.7% in March, but pull up the BLS breakdown and you'll see most of that number is just households paying more for the same gallon of gas. Gas prices crossed $4 a gallon nationally for the first time in 3 years. They're not spending more because they're buying more. They're spending more because they're being charged more for the same stuff. We're all feeling it. The household paying for groceries, fuel, and rent feels the worst it has felt in 74 years of recorded history. And Powell, standing at the podium of the most powerful financial institution on the planet, told America people are still spending on the same day the most pessimistic consumer reading ever published landed in his inbox. Which brings us to contradiction number 2, the GDP forecast that defies every other model on the planet, including the Fed's own. And the FOMC raised its 2026 GDP projection to 2.4, up from 2.3. The Atlanta Fed GDP Now tracker, which is built and operated by a regional bank inside the Federal Reserve System, had Q1 2026 tracking at 1.2%. That is a near 2 full percentage point gap between Powell's projection and his own institution's nowcast. And the trajectory is the part that should be on the front page of every newspaper. Q3 2025 GDP came in at 4.4% annualized. Q4 2025 was revised down to 0.5%, and Q1 26 was tracking at 1.2% going into the press conference. This morning, the BEA released the official Q1 print, 2% annualized. Better than the nowcast, worse than the consensus, and to make matters worse, the beat was driven almost entirely by government spending bouncing back from a 5.6% Q4 contradiction. Consumer spending decelerated, private demand weakened, and the number got hit because Washington spent money, not because the real economy got stronger. Meanwhile, PCE inflation is tracking around 3.5% year over year, well above the 2% target the Fed has pretended to chase for the last 4 years. RSM US just cut its 2026 growth forecast from 2.4 to 1.7% in direct response to the deteriorating data. So we have inflation accelerating and growth decelerating. You know, we got a word for that. It's called stagflation. Even Ray Dalio, who's usually very careful with his articulation in public, just said we're officially entering stagflationary period. The last time the United States dealt with this combination was 1971. In 71, the federal debt to GDP ratio was around 35%, and today it's hovering above 120%. But the Fed has no Volcker option this time. You cannot raise rates to 20% when the Treasury is rolling over $9 trillion in debt this calendar year. The math does not close any of the honest spreadsheets, and Powell raised the forecast anyway. Contradiction number 3. I won't see you next time. That's my favorite one. That was Powell's literal closing line. And I know he's probably said it so he could get some chuckles from the press. Definitely got it from me. There is just one small problem with that. Well, it's obviously not true. Powell's term as chair expires on May 15th this year. His seat on the Board of Governors does not expire until January 31st, 2028. He could legally stay in that building for another 21 months, and in the same press conference, he confirmed he intended to do exactly that until the Inspector General investigation into the Fed building renovations is, in his words, truly over. The DOJ dropped its criminal probe 5 days ago. The IG investigation continues, and Powell, who is a self-described institutionalist, has decided that is sufficient justification to do something no outgoing Fed chair has done in 78 years. The last chair to remain on the board after his chairmanship ended was Mariner Excels in 1948. Treasury Secretary Scott Bessent did not let it go unnoticed. His exact words 2 days ago. Bessent, April 29th, it is highly unusual for someone who says he is an institutionalist. His unilateral decision to stay flies in the face of tradition. It is an insult to his successor. A sitting Treasury Secretary publicly calling out a sitting Fed chair is in itself unprecedented in the modern era. This creates what analysts have already started calling a two popes scenario. Kevin Warsh sworn in as chair, sitting in the big seat, and the previous chair sitting on the same board, voting on the same governance. Every decision Warsh tries to make, the markets will be looking at the chair behind him to see if he agrees. And with all the bad blood between Trump and Powell, do you really think he's just going to stay quiet on the sidelines and let Warsh push Trump's agenda with no objections? No obstructions of any kind? Please, I don't think that's going to happen. Drop me a message in the comments. I want to know if I'm the only one who doesn't believe a single word of this. Now we go. Contradiction number 4. In one breath, Powell said he would, and again I'm quoting, keep a low profile as governor. He said there is only ever one chair of the Federal Reserve Board. He pledged not to be a high-profile dissident. In the next breath, in the same press conference, Powell said this: "My concern is really about the series of illegal attacks on the Fed." He said illegal. That's the word he used. He went further. "I worry that these attacks are battering the institution and putting at risk the ability to conduct monetary policy without considering political factors." And then the line that detonated the press room: "They left me no choice but to stay until I see them through." I think he's giving Trump a taste of his own medicine, and this is going to be very, very exciting to see over the next couple of years. Crazy to think watching politics is going to be that exciting. A sitting Federal Reserve chair in his final press conference calling the actions of the sitting administration illegal and citing those same actions as the reason he is refusing to fully leave his post. That is not a low profile, that is a battle cry. The last time a Fed chair publicly clashed with a sitting president at this level of intensity was 1951, the Treasury Fed Accord. The fight that established Fed independence in the first place. In 1971, Arthur Burns folded to Nixon's pressure, kept rates artificially low through the 1972 election, and lit the fuse on the inflationary spiral that took Volcker and the 20% interest rates to break a decade later. Powell is doing the opposite of Burns. Whether you think that is heroic or reckless is your political call, not mine, although I've given you my opinion. But pretending that calling the administration illegal and then promising to keep a low profile are consistent statements is something I honestly can't figure out why the press let slide. Contradiction number 5. Powell characterized the most divided FOMC vote in 34 years as the committee moving toward a more neutral place. Yes, that's what he said. In another direct quote, people are not saying we need to hike now. 3 of his own dissenters are saying exactly that. Hammack, Kashkari, and Logan voted against the easing bias precisely because they believe the data may require hikes, not cuts. Moran voted for an immediate cut. When your dissenters are pulling in opposite directions on the same day, that is the textbook definition of a fractured committee. And the bond market called the bluff in real time. The 2-year Treasury yield spiked 15 points to 4.85 inside the hour after Powell finished speaking. The VIX jumped to 18.5. CME FedWatch went from a 0% probability of a rate hike in December 26 to a 9% probability overnight. The market priced in a hike that yesterday morning had 0 probability of existing. Powell called the meeting neutral. The bond market called it the most hawkish hold in years. And the bond market is one that always tells the truth. So that is the audit. 5 contradictions sourced from the official transcript, cross-referenced against the official data. Real quotes, real numbers. Now let's talk about what the smart money did in the hour after Powell stopped talking. Berkshire Hathaway is sitting on $373 million in cash and treasury bills. You guys know about that already. That's a record. Roughly 40% of its market capitalization parked in the safest paper on the planet. Berkshire has been a net seller of stocks for 13 consecutive quarters. Morgan Stanley dropped his 2026 rate forecast immediately after the press conference. Bank of America Securities published the Warsh's likely outlook is consistent with an extended hold, not the cuts the equity market is praying for. The Buffett indicator is still sitting around 232%, the highest reading in 100 years of recorded financial markets. For context, the dot-com peak was at 163% and the 21 pandemic peak was at 219%. Buffett once said the 200% is playing with fire. We are 32 percentage points beyond playing with fire. The S&P 500 PE ratio is above 28, roughly 2/3 higher than its 100-year average of 17. 3 independent classes of capital, corporate treasuries, institutional desks, and the large individual investors on the planet are all positioned identically in cash, in short duration paper, out of risk. If you want the full framework on how the institutional fracture fits into the 18-year cycle, where we are right now in the timeline, and what historically happens in the next 12 or so months when the Fed loses credibility at this level, I put together a free 3-video mini course that walks through all of it. It is the first link in the video description and it costs absolutely nothing. It'll reframe how you read every Fed meeting from this one forward. Go grab it before the next FOMC meeting because what is coming under Warsh is not what the consensus is pricing in. Now I want to hear from you. After everything you just heard, where does this resolve? Does Kevin Warsh actually get confirmed by May 15th and inherit a fractured committee that refuses to let him cut? Or does Powell's decision to stay on the board create the 2 popes scenario that paralyzes Fed policy for the rest of 2026? Drop your call in the comments section below. I'll be reading every single one of those and replying to as many as I can, as you've seen from prior videos. Hit the like button if this audit was useful. Subscribe to the channel if you have not already, and grab the free 18-year cycle mini course, top of the video description. I'll see you guys at the next video. Until then, you know the deal. Take care. Peace out.